I want to capture an essence of how you, as a chairman of a domestic bank, view the economy of India and the impact that the foreign inflows is having on the economy of India. How would you read how India is developing today?
No, the way I look at India, it's a country which is being rebuilt. It's a very interesting country today. You go to any part of the country, there's a huge amount of activity taking place. Airports are rebuilt. Small centers. You visit. I went to Mangalore a month back, which is where my career was built. But it is with a gap of about 1.5 years. A new airport. You find ports being rebuilt. The roads are built. A whole amount of investment taking place in infrastructure. A huge amount of migration taking place to urban cities. The urbanization in its peak happening. Now, education, the pressure on education, pressure on so many things. So what you're really seeing is a country in its rebuild situation. So when the economy grows, it is given, if you have a good governance, country's economy will grow at about 10%. If you have some handicap there, because it's a democracy, anything can happen, then you have 1-2% less. But in a medium-term basis, 20-30 years, the growth is settled. In such situation, the banking sector, which is a reflection of the economy, the key challenge is to create capacity, and that is where the foreign flows gets into. It's an opportunity which any foreign investor should look at. There are issues. There are issues with the government. There are issues with approvals, but then there are huge amount of opportunities. They're all being sorted out. But fact of the matter is, the one who is looking at the country, one who would like to invest in the country, is the best time to be in.
That's for the foreign investor coming in, but how much of this development is the average man on the street in India benefiting from? Education levels still remain low, healthcare, mortality rate. There's a lot of work to be done on that front, and it seems that the corporate world in India is speaking one language, and the social world is speaking another language today. Do you think that the corporate world's progress is sustainable if some of the social indicators are not dealt with?
I think, let me put it slightly differently. In last 2 years, the government's at this time the government is focusing on inclusive growth agenda. The inclusive growth agenda encompasses the large number of those who were not touched with growth opportunity in the past. 37% of the government allocation is going for the social sector. In effect, it is social security being given in a slightly different form. If you go to a developed country, you find if you are unemployed, you get a social security benefit. But here, it is 100 days of job that is being given, which is social security. You are actually giving employment by way of social security benefit. It's a totally in a different way. Look at the 4 major initiatives that came in. Right to education, right to information, right to employment. Now, these are the path-breaking initiatives, which will take reasonable number of time to have its impact. But I, as a banker, when I move in a village today, I clearly see the migration is coming down because there are 100 days employment in a village. Look at the consumer, goods industry. Their maximum sale is taken from the rural markets. So there is a market getting opened up. One. Now on the education side, it's a debatable question whether they are employable is a debatable question. There is a huge amount of emphasis to educate people. So, I mean, it's, as I said, it is a country in the making, a country under, being rebuilt. But the intent is very clear, to reach out all those who have not reached in the past. That is the reason I said, if the governance is very good, 10% growth is bound to happen, because all of them are contributing to the growth process.
You mentioned that Union Bank has a focus on retail banking. That's like the last 5 years, and in a way that was the flavor of the time that many banks wanted to focus on the retail banking business. Do you see a need to also focus on the small business sector, and what would you be doing?
As I mentioned, we went through a major transformation process. Started from 2007. The focus of transformation process was clearly focused on few segments. The first, retail segment, where we came up with the products, processes, what we put in place, what we call union loan points. We offer all the channels so that the new generation customer also feel comfortable, while the branch as a channel is also offered by opening large number of branches, because the present customers, they are more comfortable coming to the branches. We didn't want to restrict on the brick and mortar branch and go only for the online. We offered all the channels. This one for the retail, but we simultaneously focused on small and medium enterprise. We opened up what we call as a business banking branch, 250 of them, located in SME clusters, and improve the process by creating centralized processing teams. So that's another major focus on the small businesses, medium enterprise business. At the same time, we also focused on the large corporate, because also a major segment of ours. So we opened up what we call a large corporate vertical. So the focus was on all three group, because all three group are banking with us. But then technology was the real enabler. I think we clearly brought in the technologies ahead of competition. More importantly, it's not the technology which is being brought out, but we were able to transmit it into customer experience and offer services, customizing the product offering using the technology. That's where the benefit accrued to us.
So even as you broaden your business base and use technology to reach out to a greater number of customers, and I'm sure that you're also doing work on the channel front, an average commercial bank is only as good as its top 10 customers. And all you need is one bad loan for your biggest exposure, and the story will be very, very different in that sense. Do you have such concerns?
Actually, where exactly we actually give credit to our regulator is that our exposure to any group is not, is also restricted based on our capital. So I can't lend, even if I want, a substantial portion of our resources to one group. So it is restricted. But internal policy, we don't expose ourselves to any sector more than 20%. Even though we are focused on retail, the maximum as a policy we go is up to 20% of our portfolio. So too it's in the large corporate or the infrastructure. We capped it about 20%. So there's a very clear risk management policies in place. So the top 20 customers account for a total exposure of about 25%.
And so you're happy with the loan books, but you did see your NPLs go up a little bit in the last year or so.
Last year.
So where was that coming from?
Yeah, this is it's very interesting, because the technology also gave us an opportunity to bring in total transparency in the way the NPLs are identified. So we took that advantage during this year. Second, we had an issue around agricultural loan waiver, which was announced by the government, and the culminating month was September of this year, where the agriculture relief scheme, which was offered as a benefit, where the payment has not come, was recognized as an NPL. Post economic crisis, those restructured account, the last date for restructured period getting over was June. So all these three development happened in 1 year. So I mean that's how the NPL has gone. Even then, we had anticipated this. I had given a guidance that September 2010, the NPLs will peak and start coming down. Now, NPL as a percentage, gross NPL was 2.79% in September, has come down to 2.68% in December, expected to come down to 2.40% in March. But post 2011, it is expected to steeply come down. My credit cost is expected to come down to 50% next year onwards. So this was a exceptional year as the NPL is concerned. With all these things, it is still at about 2.68.